my guests, Ganeshram, Jayaraman. Thank you for joining in. Before we talk about that wonderful note, I have to ask you about what is arguably the biggest development uh, in, in, the, in Indian capital markets for 2022 thus far, probably for the rest of the year. And certainly the biggest development in the BFSI space. The merger of HDFC and HDFC Bank came out of the blue. A lot of people have been talking about it for years now, Ganeshram, that they should do it, so on and so forth. What is your take on what it does for the two entities combined?
So, good morning, Neeraj. It's always a pleasure being on the show.
Thank you.
So firstly, to discuss this piece of news, I cannot talk individual stocks, but a quick heads up is, see, from the bank's perspective, for their growth objectives, mortgage was extremely important, and given the parent was predominantly the managing the mortgage side of the business, the home loans, it kind of put a challenge on the bank's growth outlook. And from the parents' perspective, being a monoline business predominantly, and also being a holding company, had its own set of growth and valuation challenges in terms of holdco discounts, in terms of growth objectives, or where else they could diversify their growth, and also from a management depth or the longevity of the existing parents management team. They needed to find some answers, and the answers, everyone in the street always knew that the answers was in the bank, but finding an elegant solution in terms of timing, or in terms of the answers for both the CRR, SLR, priority sector, and various other questions. How does the the subsidiaries now get subsidiaries of the parent, the non-bank businesses, basically the life and mutual funds and others. So we need to still get some answers. We still want to figure out, as we speak, the call is on. So let's see if that call gives us some answers. But as of now, we don't have absolutely clear answers on how the structure will evolve to become. I think there are a lot of questions there. Maybe it's getting answered as we speak. But yeah, I think for the longer term growth objectives of both the parents' business as well as the bank's business, this was an eventuality, inevitability, and it does, because the bank's market share in most other loan products, the retail loan products, were reaching levels where beyond which there could have been very little upside for them. But in home loans, there is still a lot of upside, and that will also be the growth driver. And without a meaningful, large presence in that piece, the bank's growth could have been impacted. And I think this will be a very critical strategy for the bank, for the merged entity now to be looking at growth in excess of return on equity is now actually possible in the newer context, and that will be a re-rating driver. The fear with investors was, especially over the last 2.5 years, that for the first time in more than 20 plus, in fact, right from the time the bank started, for the first time, growth fell below return on equity. Okay, because their market share in, be it in auto loans or credit cards or personal loans or most other retail segments, had reached 20-25%, and they needed to get the mortgage side of the business right. And the second one is from the solutions for the longevity of the parent. This was necessary in terms of management continuity and various other questions, which not everything I can speak in a public forum, but kind of this was necessary, and we still need some clarity on the structure and how the subsidiaries and how those will play out. Regulatory questions are there, CRR, SLR, and others, but I think it answers some key questions for both entities. There are still some unanswered questions which need some clarity. That's what I will, as the first impressions of this news gives me to point out.